Hey there, everyone. Today on the Final Bar, potential reversal day. The S&P and the NASDAQ erasing some of their initial gains. Nice rally in the afternoon, settling off a bit into the close, but the S&P basically unchanged for the day after a noisy session. Apple, other key growth stocks seem to be breaking down through key support levels. Guest today, Joe Rabil of Rabil Stock Research. We'll talk about some multiple time frames. Can they help us better understand the current market conditions? Ladies and gentlemen, this is the Final Bar. Hey there, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action using the power of technical analysis. I would argue an astute investor, a well-informed investor, is focusing on the evidence, having good, what we call situational awareness, having a good recognition of what's happening around you as an investor. Now, I'll tell you, the signals sometimes seem very straightforward and very clear. I would not argue this is one of those times. This is a challenging time, and I will tell you from conversations with a lot of my guests as we come on, just sort of looking at different evidence and thinking about things. There are times like mid-2021 where it seems like such a clear constructive pattern, it seems almost obvious, right? In mid-2022, a clear pattern of distribution. Right about now, it's sort of a could be this, and thinking about different indicators, different measures of breadth, different levels to pay attention to. But there's no denying from Wednesday afternoon last week at 2:30 p.m. when Jerome Powell started talking to right now, we've been overall in a pattern of distribution. Now, we're still holding above some of those key levels, but days like today and weeks like this where you're threatening to break down is where I think about further distribution and just thinking about managing that downside risk now more than ever. Kind of an appropriate time to do so. We have a great guest today, by the way, Joe Rabil, talking about a couple different time frames on the S&P and some other names as well. So I'm excited to get his perspective on a noisy and challenging market to pay attention to. Let's get to our market recap, see where things played out through the course of the day during today's session. Before we get there, a quick question we asked you recently in our polls. So make sure you follow us on social media, subscribe to our YouTube channel. You won't miss the next question. We asked you, where will Amazon be 1 month from today? At least 10% up, at least 10% down, 0 to 10% up, 0 to 10% down. The most common response, and it was pretty widely spread between all of them, which tells me a lot about current market sentiment. Kind of all over the place, right? We had 20% over 10% higher, 21%, the same number of responses saying at least 10% lower, and that's within a group of people over the last 24 hours, and I think that speaks a lot to sort of this period of uncertainty that we find ourselves in. Overall, the most common response was between 0 and 10% lower. Let's look at a chart of Amazon and see where things are at. So if you think of us around 125, we'll call it 125 and change. So 10% higher would take us around, just above the 50-day moving average, right? Sort of in the 137-ish kind of range. 10% lower would basically get us down to the 200-day moving average. So it's kind of interesting. We're right between the moving averages. So the question is, do we, trade up in this area between current levels and just above the 50-day? Do we break above there, get above 140, and we're talking about a new swing high? Do we get down to the 200-day moving average, or do we get lower? And those kind of responses sort of in this range, which I would argue that's probably the answer I would make, only because I don't see enough on the chart yet telling me that this distribution phase that really started in earnest last week is done yet. You could see today as a bit of a capitulation day. We talked yesterday with Don Boley about capitulation, what that might look like, some of the candle patterns that might speak to it. Earlier this afternoon, as I saw the S&P and the NASDAQ go green for the day, I'm thinking, oh man, there's your hammer candle kind of going up. It looked less and less like one of those as the afternoon progressed and we got to the close, but certainly some buyers coming in midday. This is during Biden's comments in the afternoon about AI and the promise of AI. I'm not super optimistic that alone is a great reason for stocks to go up, but it did certainly go higher, and that's the most important message. So on Amazon, I think the underlying observation here, the most important one, is we've stopped making new highs. We've now broken below the 50-day moving average, which is sloping downwards. We've gapped lower and have continued selling off. And until those kind of things change, I would argue the path for now is down rather than up. So I would agree with that. Sort of between 0 and 10% lower makes sense to me. Thanks so much, everyone, for answering that poll. These questions are really designed to make you think. Think about different outcomes. Think about what would happen if stocks that you're looking at had those sorts of significant gains in the next month. what sort of signals and opportunities you may find as the market would progress. Let's keep going with our market recap. As I mentioned, sort of a choppy day, and until around 1:32 p.m. Eastern, it looked like yet another distribution day, and today looked a lot like yesterday. It was sort of a rhyming pattern or an echo of yesterday's distribution day, just opening and then just trading lower pretty consistently. We had this big rotation higher right around 2 p.m. Eastern, put us net positive and was pushing the S&P very close to 4,300. It wasn't to be. The S&P finished flat for the day, right around 4,275, and that's literally a rounding error from yesterday's close, right about at the same point. The NASDAQ finished slightly higher, still below 13,100, just up less than 0.25%, and the Dow was down about 0.2% as well. Mid caps and small caps both positive. The S&P 600 small cap index actually finished up by about 1%, so a bit of a divergence from the broader, the large cap S&P 500. The VIX, again, a choppy, noisy session, and earlier in the day, it looked like the VIX might actually get to 20. And why is that important? Because, again, with something like the VIX, I usually have that back of the envelope number, right? If I know nothing else about the volatility conditions, if the VIX is below 20, that's a low volatility environment. If it's above 20, it's a high volatility environment. And that on its own just tells me the overall conditions, and then I want to dig deeper into the price action and see what I can see. So very close to the VIX getting to that high volatility threshold of 20. It pulled back in the afternoon as stocks rallied. At the end of the day, finished just above, I will call it 18.25, 18.25 or so. So again, still pretty elevated relative to where we've been the last couple months, but pulling back from where we were midday today. Now, a big part of the conversation with stocks, and particularly with growth stocks, has been higher interest rates, and that trend just continued today. 10-year yields finishing above 4.6%, the long bond yield around 4.73, 5-year point around 4.70 as well. And the short end of the curve obviously still elevated over 5%. So you have that inverted yield curve still in place. The mid-long end of the curve continues to go higher. This is as bond prices are coming down. We had a really good live Q&A earlier today, by the way. If you missed our live Q&A on our YouTube channel, it's posted here on YouTube. Make sure you check it out. Good discussion. We actually went to a number of different things. I was asked about recessionary fears. We were asking about the durable goods orders and how that related to price action. Talked about all sorts of different patterns and breakdowns and inflection points. So it was a really good conversation. But one of the things that was asked about was some of the economic data. And my point was, remember that this idea of higher rates isn't just a one-day thing, right? It's not just a one-day thing of rates are higher, what does this mean for stocks? I would argue this is more of a broader macro theme that will be part of the story of 2023, right? Think about at the end of the year, right? In years to come, you'll look back at 2023. What described this environment? I would say the Fed interest rate policy certainly a part of it, with the short end of the curve. Long bonds or the longer end of the curve, going higher and higher, certainly a very big part of that. And then just recognizing how that as an overall headwind to growth stocks can keep our benchmarks lower, I think has been a key thought of mine, and really has not played out particularly well recently as rates have been higher and growth stocks have been okay. Just recently, you've seen growth stocks rotate lower, I think in recognition of the conditions that have been sort of evolving for months and months now. The dollar going higher by about 0.5%. That's another interesting chart to watch. Stronger dollar has not been particularly good for risk assets, generally speaking. Gold and silver continuing to go lower. And I was talking with Joe Rabil, my guest today, earlier about Newmont and some of the other gold stocks just not performing particularly well. Surprisingly so, in my opinion, right? I would have expected gold to do a little bit better, particularly as a bit of a safe haven, given the fact that growth stocks are coming back. But you're not seeing a rotation into things like the GDX. The GLD is down another 1.25% today. Silver prices moving lower as well. Now, the energy side of commodities doing just fine. The energy sector outpacing all other sectors, and it wasn't even close. Firmly at the top of the sector list today. Kind of a choppy session for Bitcoin and Ether prices. Bitcoin actually traded just above 26,800 earlier today, settling back down just above 26,000. But again, sort of a flat day, end of the day after the move higher and the move back lower. Ether prices, same thing, about 0.2% higher, but no real significance there. I would say overall choppy more than anything. Finally, let's look at the sectors. As I mentioned, it was sort of energy and everything else, which is a familiar sort of pattern that we've seen and observed many times in 2023. The energy sector, the XLE, up 2.5%. And when I was scanning for stocks making new swing highs earlier today, a lot of energy on the list versus other sectors. And to be clear, there weren't many stocks making new 3-month highs. There was about an 8 or 9 to 1 ratio earlier today of new 3-month lows to new 3-month highs in the universe that I work with. But overall, energy certainly the top performer by any stretch recently, up 2.5% today. Industrials number 2 with the XLI up 0.8%. Then communication services up 0.3%. On the bottom, you have utilities getting crushed again here, down about 2%. Real estate number 2 from the bottom, down 0.9%. Consumer staples, so fairly defensive sectors at the bottom of the list today, all losing ground, certainly relative to the S&P 500. Let's go to the daily chart of the S&P and just sort of see where things are at. So when you look at the S&P, again, we've talked about whether this is an ABC sort of pattern, whether this is a head and shoulders top. I would say regardless of how you label it, we're certainly in a period of distribution until proven otherwise. Now here's today's slightly moving higher, right? Again, a choppy day, and earlier it looked like we were going to close back above this trend line, which is, I would argue, a really important one. This is taking the low from October of last year, from March of this year, lines up pretty much with where we're at today. Yesterday, we closed below that level, and if we had a reversal back above, that would have been, I think, a really interesting, maybe short-term capitulation signal. I don't think you really got that today, because overall, sort of choppy, noisy, but remaining below that trend line support. Also remaining below 4,300 for the entire session today. It's another important level to pay attention to. So my general bias is seeing this as a weaker environment until proven otherwise. And I would say that because we've now made a clear lower high, we've made a clear lower low, and that's not what bull markets look like. So let's look for a change in that pattern, back to higher highs and higher lows. We can talk about starting to get a little more constructive, but for now, not quite there. The VIX, as I mentioned, bouncing higher. Now today, it was sort of looked like it was going to get almost to 20, and earlier in the day, it was up here, right in this blue shaded area. When I was reviewing the charts just a couple hours ago, around 1 o'clock Eastern, 2 o'clock Eastern, VIX had spiked very, very high, and it looked like, oh man, this may be the day when we break above 20 for the first time since the first quarter, really, since mid-March. But wasn't to be. The VIX actually settled back down below yesterday, and again, still above 18, still fairly elevated relative to where we've been the last couple months, but popping down a little bit. Again, higher VIX, higher volatility usually means higher uncertainty. The fear gauge is what a lot of people would call it. I think overall it's just a measurement of volatility, of uncertainty. And so the higher the VIX, generally speaking, the weaker that implies stock prices are going to be. Now, we talked about interest rates, of course. So, as a reminder, you see the $TNX, the 10-year yield, continuing to make another high here. And again, when you take a step back from your monitor, you ask your 7-year-old son or daughter, is this going up or going down? I bet they would answer a particular way. And I know if I showed my son Henry this chart, he'd say, yep, it's going up. And he's right. And I think keeping it that simple, there's nothing wrong with that, right? The 10-year yield is making higher highs and higher lows. It's above 2 upward sloping moving averages. The overall trend in rates is going up, and that is making things more expensive for consumers. And there's a lag of sorts, right? So, I mean, when you go to a store, you may not feel this sort of impact day to day, but if you go to buy a car or go to buy a new house, you will start to see a huge impact. If you have an adjustable mortgage, an adjustable rate mortgage that resets based on interest rates, you're probably getting a big upgrade to your mortgage payments because these are the conditions and how they've evolved. So there's a bit of a lag when rates go up and the implications that they have. And that is, I think, one of the many challenges for the Fed is some of the things that they would do and some of the things related to decisions they will make often have quite a lag between the decision that they've made, the change that they make, and the implications, right? The effects that they have are measured way down the road. Now, when I'm thinking about breadth conditions, overall, I would describe the breadth conditions as not particularly strong at the moment. We talked about the McClellan oscillator going below zero here recently, just confirming that we're in a down leg, a distribution phase. I'm now starting to bring up some of these breadth indicators to find a downside capitulation measure. Now, this is the Bullish Percent Index for the S&P 500. This basically says out of the 500 charts in the S&P, how many of them are bullish using their point and figure charts. And so this is a percentage of bullish charts. That's why it's called the S&P's Bullish Percent Index. And we run this sort of calculation for a number of different broad market indexes, also for particular sectors and market cap styles as well. So right now it's around 37%. Back here in mid-July, it was around 80%. So 4 out of 5 stocks in a bullish point and figure chart. When that indicator breaks below 70, after going above 70, then it comes back below, is one of those key sell signals telling you everything, basically everything's been going up and now you're starting to see a change. The opposite, these green shaded areas indicate when the indicator goes below 30% and then comes back above. And you can see the last 3 or 4 signals at some pretty significant inflection points, right? The March low was the last time you triggered this sort of traditional buy signal. We went below 30%, telling you everything was kind of going down. And then we were coming back out of that oversold region, that 30% level. Found the same thing at the October low of last year, then also other lows in June and May of last year. Now, it's not at every bottom. So you can see here in December, you didn't really get down to that point. So there's no guarantee. But what I would say is this is one of those indicators that when it does trigger, it tells me to be pretty confident that we're at or near an inflection point. So we're close to initiating that potential buy signal. We'd have to get below 30%. If we continue to distribute rest of this week into next week, I wouldn't be surprised if we get closer and closer and even complete a move below that 30% level, at which point we start looking for the buy signal, start looking for the capitulation. Not there yet. Just to finish off here, our market recap. We had so many places we can go on a day like today. We're going to talk with my guest today about energy. So I don't want to spend too much time looking at some of those charts, but I will say 2 growth names to pay attention to. Alphabet, we highlighted this week how it broke below the 50-day moving average. The last time we did that was here in July, again, 2 times in July, actually. Both of those times we actually moved back higher, ended up making a new high at the end of the month of July. Now we're back to the 50-day. We've broken below it. So if we can get back above it, that would certainly alleviate that bearish signal. But we're also testing support right here. Remember what I said, an uptrend is a pattern of higher highs, which we've gotten, and a pattern of higher lows. If we don't make a higher low, if we break below what's called around 127, we'll call it, that would be a lower low, and that all of a sudden would potentially change the configuration of Alphabet. Now, that is one of those outlier stocks that has continued to show strength. Look at Apple. You don't have to go too far away from mega cap FANG stocks to find examples of stocks that are not holding their recent support levels. While Alphabet's still arguably in an uptrend, Apple, I think no argument, it's certainly not in an uptrend because we've made a lower high clearly in August of around 190 and now undercut the low from August. So overall, we've now gone to a distribution pattern. Again, until that is changing, it's hard for me to get excited about a name like Apple. I want to bring on today's guest, Joe Rabil. Before we do so, a couple quick announcements. First off, we would love to hear from you, particular questions. We had some great questions coming into our live Q&A earlier today. Our mailbag is always open. You don't have to wait for Wednesday at 1 p.m. Eastern to send us your questions. Just shoot us an email, thefinalbar@stockcharts.com. That's the best way to get your questions in front of us. On X, just tag us in a comment @FinalBarSCTV. On the YouTube, just put a comment below the video you're watching. We'd love to hear from you. Hope to answer your question in our next mailbag show, which will be Friday of this week. Also, as a reminder, that live Q&A runs every Wednesday at 1 p.m. Eastern. We plan to keep that going here for the foreseeable future. So make sure you tune in next Wednesday, 1 p.m. Eastern, for a live interactive Q&A session right here on YouTube. I want to bring on today's guest, Joe Rabil. Joe's the founder of Rabil Stock Research, coming to us live from Fairfax, Virginia. Joe, you are in a happy, smiling mood given the market uncertainty, so I appreciate your overall optimism. How are you these days, okay?
Good. No, it's just great to be back on the show. I always enjoy this.
No, it's good to see you, Joe. And as always, you always bring charts that make me think, and I appreciate that. I know our viewers do as well. When you're looking at the S&P, obviously we've had quite a bit of noise here today, in particular, one of those choppy sessions. It felt super negative, super positive, sort of turning on a dime. Take us through your monthly chart of the S&P. How do you make sense of where we're at right now within the larger trend?
So, I mean, we make this low in October last year. We push up a little bit, go sideways, and then we finally get through. To me, the key level was 4,200. I know a lot of guys were looking at 43. But 42 was sort of like the reversal of the trend using a 1, 2, 3 basis on a weekly chart. But so 4,200. So if you look at what happened, it crossed above that 18-month line, which is that magenta color, and it never checked back. It just kind of took off. And when you cross a declining moving average, you tend to expect some form of a check back or test of some kind at some point. The problem was it just kept pushing and pushing, and now we ran all the way up into resistance. So I just think this chart sometimes just taking a step back and looking at it and saying, this totally makes sense. This needs to pull back. We've got a tremendous amount of support underneath now from 2 major moving averages, and you can tell where it broke out from around 4,200. We got down to what, 4,250 or something like that today.
Yeah.
So that's, I mean, I think that's just, it's sort of doing what you'd expect. Now, what I'll say is, if we don't hold this 4,200 level, that would scare me a little bit. Like if we come down through that in a violent way, then I think you have to start rethinking, is this just an orderly pullback and we're getting ready to go up again, right? And so
Yeah.
that's kind of how I use this chart, because if that plays out that way, we've got this big red bar on a monthly basis, maybe closing near its lows, and then we get follow through the next month. Does the MACD want to hold its signal line on this pullback? All these things start to come into question if you don't hold the 4,200.
Yeah, I feel like that level seems to be getting closer and closer as the month of September continues. Your weekly chart. Before we started, we were talking about some Fibonacci measurements. Talk to us about the weekly, how that relates to what we just said.
Yeah, so it's interesting. So if you take the low from March and to the high of the most recent high, that Fibonacci level, the 50% retracement is 4,200. All right. So what I do, I know you could take it from the low in October, but I like to take it from the last leg and then measure the 50% mark. If we hold the 50% mark in the last leg, then the momentum is confirmed by the Fibonacci, in my opinion. That's how I look at it. And once you start breaking the 50% of the last leg, you're losing momentum. Now, you can stay in an uptrend as long as you hold the 62%. But if you break the 50%, you're losing momentum. You're not going to just go straight back up. So we're at it. I mean, I don't think we can go straight back up just based on the damage that's been done. I think the odds are, even if we find support at 4,200, we're going to turn into a consolidation pattern, because we broke the 18-week. We've damaged a lot of charts on their intermediate term trend. But let's look at the daily chart real quick, because we got to start respecting, like, I mean, yeah, oversold can continue to go oversold, but look at how far we're getting away from these short-term moving average in 18 MA is not that, it's not, I mean, you can get pretty far away from a 50 or something like that, but in 18, you get stretched like this, it acts as a leash and it'll pull it back. So, we get this little bottoming tail. It's not confirmed yet, but we're getting into the area where I'd be thinking we got to have some form of an interim rally, even if it's a part of a downtrend. You'd think you'd get some kind of a bounce in here, and then you can evaluate the quality of the bounce. And if the quality of the bounce is good, then maybe we're starting to make a bottom. If the quality of the bounce sucks, then you're looking for another leg to the downside. So that's how I would view it.
It's so funny because I think a lot of people think very simplistically, like, is the market going up or down? And you draw conclusions based on one thing. What you have to remember is, in a downtrend, you always have those counter trend moves bouncing back higher. So even if we do get a bounce, that might not be the all clear, we're going to retest new all-time highs. It might just be a normal sort of, reaction to the fact that we're coming off a new low, I guess, right?
Yeah. And I think, if you think about it, we have a down August and we have a down September. I mean, odds are, just historically speaking, I don't look at this stuff a lot, but if you just look at, any almanac about the market or whatever, I mean, odds increase that we're going to make some kind of a bottom in October, even if it's an interim low. You got to kind of respect that. So maybe we get a little bounce before and then come back down and make a new low in October. And then we have the makings of something like Tom was talking about yesterday, a climax. I don't think the volume is good enough to call this a climax. It wasn't a strong bar. It's not what I would think. I wouldn't associate that with a climax signal. So I think it's coming, though. Maybe that's sort of what I'm looking for too.
No, it's a really good point. Volume a lot of times is a really good component of that thought of having capitulation. Capitulation usually is a pretty high volume event. We didn't get that today. That's totally fair. Talk to us briefly about small caps, because this is one area of the market certainly has been lagging behind mega caps overall. What do you see on the IWM? What does that do to fit your overall perspective here?
So first of all, let's just look at the price chart. And I've got this zigzag chart up so you can clearly see the three tops up there just under 200. I mean, to me, 200 was the key. If we got through that, then all of a sudden you get an expansion of participation and you start to feel a lot more confident. But that's not what's going on here. And I can tell you that when the relative strength line, the black line in that second scale is below its moving average, I've followed this for close to 20 years. It's not a good thing for the stock market. All right. I mean, I've been dealing with small cap money managers forever. And this is a component that I've watched this relationship for a very, very long time. And when that's dropping, it's not a great environment. Doesn't mean we're going to crash or anything. It's just not conducive to markets breaking out and following through. So I always key on this IWM. I just kind of want to see, okay, so today was a good day. The market was not trading well, and yet all day long, the IWM was up, and it was up pretty substantially. So that's kind of the first sign. It kind of agrees with what we were talking about with the S&P, that maybe we're getting a little bit closer to some kind of an interim low.
Yeah. Feel like we still need to see some more before it would feel really good. And I love you pointing out that 200 level, Joe. And no doubt we've been remaining below there.
Yeah.
Let's talk about some individual names. You had a couple that you brought with you in this sort of environment. I think a lot of people struggle with just think about where they want to rotate or what sort of opportunities out there. Where are you seeing opportunities now?
Yeah, and so I did this specifically. I wanted to just look at the monthly chart because the fact is that you can go and look at energy, which this is an energy stock, right? But what I'm trying to point out here is there's something changing with this company. And I'm no fundamental guy, but I can tell you when I look at a chart like this that something is shifting. This is not some ordinary situation where we're getting a trade. This has been developing now for 6 or 7 years, and now we're starting to emerge out of this. So I would want to focus my efforts on stocks like this that have the makings of something where if the market does turn in here and wants another leg, I want some pretty good bang for my buck. And I think this is the type of stock that could do that for me.
When you describe that there's clearly something changing, can you be more specific? Like what on the chart is it? I mean, it's a broad basing pattern. So the fact that we've now sort of been consolidating and now breaking out, or what on this chart sort of tells you this is something different, something's evolving here?
So we peak out in 2014 and drop down for a few years, and then we go sideways forever, right?
Yeah.
Now, if you look at the very bottom of the chart, well, there's two. Both the MACD lines are crossing above and holding on a pullback. That's key for me. Like you can, the MACD line can cross and then just sink right back down below. But this actually crossed over and on a pullback held while the price was holding the 18-month. And then look at how the green DI, which is a sign of the buyers. And this is a monthly chart. So this is a longer term. That's the first time since 2015 that that's crossed above that black line, that horizontal 25 line.
Right.
So there's just signs of a shift taking place here on a much bigger time frame.
That's super helpful, Joe. Let's go to chart number 2 here. Genworth Financial is an insurance name, right?
Yeah, and it's, I mean, you could take the name off this. Look at how it dropped in 2014, went sideways forever, and now we're starting to get this emergence. And again, the MACD is sort of the tell here. You get the move up, and then during the pullback, I really like to see the MACD holding, especially the zero line, but in this case, even the signal line. Both of those are above zero. It's just a sign of improvement. And then again, we got some green DI. It's still holding well above the red DI, which is the sellers. It's not above 25, but it's showing signs of life. And so I think this might take a little while to get going, considering it's in the financials. And we were seeing some improvement in insurance, but just, like to see a little bit of follow through or maybe a bottom made in some financial stocks in some of these banks improvement. I think something like this could do really well.
Your last chart, Yelp, a consumer discretionary name. What's the idea here?
Yeah, I mean, it's sort of the same idea, big drop sideways, but the sideways was really sloppy. You could almost look at it like an inverted head and shoulders pattern in a way. But again, so I like to look at this ADX and MACD and just to get a little bit more confirmation of the last leg. We're emerging again to the upside. We've got green DI going. We've got the ADX line rising. The blue line is actually starting to rise a little bit. And I'm not saying, I think this might take a little bit more time to get going, but this is a stock that's on my watch list. I'm watching this. This is like if we get another leg out of some of these consumer discretion or, whatever category you want to put it, some of them put this in the tech category.
Yeah.
Whatever it is, you start to see those areas start to emerge again. I think this trades really well for that.
Joe, this was awesome. This was like a 10-minute masterclass talking about multiple time frames, and I appreciate so much these monthly charts. I feel like we get so sucked into the day-to-day, minute-to-minute movements. This is a great sort of reminder of the importance and the value of looking at long-term technical patterns. Joe Rabil, great to see you. Be well there in Virginia. We'll talk to you again soon, all right?
Thanks a lot, Dave.
That's Joe Rabil. Joe's the founder of Rabil Stock Research, coming to us live from Fairfax, Virginia. Again, Joe spends a lot of his time working with institutional investors, money managers, and has made a successful career out of identifying long-term reversals. If you notice, when I tried to ask him, what really made it a constructive chart? If you look, he was talking about indicators like MACD, the ADX line, the DMI. Those are Wells Wilder indicators on the monthly time frame, just to sort of reflect on how conditions were changing. And I love that combination of price action, confirming that with some of the indicators below the chart using our ACP platform. That was well done. You can catch Joe Rabil, of course, on his weekly show on Stock Charts TV, Stock Talk with Joe Rabil. I encourage you to check in there as well. Folks, we got to wrap the show. Go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. So funny story about this chart. I had a daily chart of the S&P 500. I first put this up about 1 p.m. Eastern, and then I had to keep refreshing it because I'm like, all right, my 3 in 3 chart is getting different by the moment here. At the end, it looks like a bit of a hammer candle the way that I set this up. But again, I feel like it's a question mark. I thought Joe's comment about the lack of volume, that's well said, and I think a really good point. When you have capitulation, you often want to see a big influx of volume. That usually suggests that bigger institutions, there's a lot more activity sort of, creating that change. But from a pure candlestick analysis perspective, this is a hammer candle. It's a reversal candle. Telling you the next 1 to 3 bars more likely higher than lower might be something to watch. This is on the SPY. I didn't see this, broadly speaking, with a lot of other stocks, to be clear, but certainly something to watch on a day that looked really negative until the afternoon and then started to pop higher. Let's see if we can get any upside follow through. Now, chart number 2, one of the reasons why I'm not super optimistic that scenario is going to play out is because of the weakened breadth conditions. Again, I thought Joe Rabil's comments about the small caps, a lack of small cap participation, really well observed, and that is one of, I would argue, just a measure of breadth, a measure of participation from some of those higher beta, higher risk names. Now, if you look at advanced decline data, just raw advanced decline data, ignore what the market is doing and just look at the trend based on the daily measure of how many stocks are closing up or down. Are these lines bullish going up or bearish going down? And I think pretty clear going down. Now, this is what happens if this would be sort of a big reversal day. Let's say this is the low for September and we rally straight up from here. I don't think that's going to happen, but it might. If it would, these advanced decline lines are going to start turning higher because enough stocks will start to improve and daily returns will be more positive, more constructive, and the trends in these will reverse. But for now, the advanced decline data all below descending 50-day moving averages, all making lower lows and lower highs. I will be more comfortably optimistic when these lines are not going down. They are still going down through today. Finally, Marathon Oil, great point on energy, and we talked about rising oil prices, just the general conditions, the energy sector, the top performer today, and that's been a familiar theme in recent months. If you're looking for stocks that are in constructive patterns overall, charts like MRO, I think, are pretty good examples of that. What's interesting on the chart here is if you look at a Fibonacci analysis, you take the high from last November, you take the low from March. If you look at what's happened, we're actually getting very close to that final Fibonacci resistance level. It's currently around 29, we'll call it 28.20 or so. We're really close to that. Now, we've had a rally up to around 28. We've stalled out a little bit and pulled back to the 50-day moving average. A lot of energy stocks pulled back in a similar fashion. All of them this week appear to be turning higher, certainly today. I think this chart getting above 28.20 or so, getting above that Fibonacci resistance level, there's not much on the chart in terms of resistance up to the previous highs. And I think that uptrend that we've seen in crude oil, the uptrend that we've seen in energy stocks for now seems to be in pretty good condition. Folks, that's a wrap for the show. Thanks so much for joining us every weekday after the close for our show, The Final Bar. Special thank you to Joe Rabil of Rabil Stock Research joining us from Virginia. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.